Usman, let's start.
Hello. Am I audible?
Yes, you are.
Okay. Hi, everyone. I welcome you all in today's webinar. Good afternoon. My name is Usman Hussain Khan. I am working as an audit manager with athGADLANG. It's my pleasure to be the moderator for today's webinar. So, just a quick overview of the agenda which we're going to cover today. Key lessons from year one of the tax year, which was 2025. What's new for year 2026, filing, audit readiness. We are going to cover how tax and audit connect. We're going to cover how the points regarding artificial intelligence in tax and audit, and at the end, of course, the Q&A session. Quick introduction of the team. Like I mentioned, my name is Usman Hussain Khan, Manager Audit. I have over 11 years of experience in audit across the UAE and UK. I've worked with the big four firms like KPMG, and I'll pass on the mic to Mr. Aslan for the introduction of themselves.
Thank you, Usman. Good afternoon, everyone. My name is Arslan Mushtaq. I'm the tax partner at athGADLANG. It is a pleasure to welcome you all today. So last year's filing session gave us practical picture of where businesses needed to focus, getting the fundamentals right, reconciling tax returns to the financial statements, and retaining clear support for the key tax positions. We are also seeing that FTA has taken an active audit approach throughout our audit support during the FTA audits. A consistent theme is that the FTA expects businesses to explain their tax treatments clearly, reconcile it to the underlying records, and provide supporting evidence promptly. This year, the direction is very clear. Compliance is becoming more detailed, more digital, and more data-led. I'll focus on the changes affecting the 2026 filing cycle and the practical action businesses should take now before the return is due or an audit query arises. The key message is simple. These are not just return completion issues. Several require decisions, records, and systems to be put in place during the year so that the businesses are audit ready as well as filing ready. Usman, then let the other speakers introduce.
Of course, just give me a moment. Sorry. I think Nisarg, I'll pass on the mic to Nisarg, who will be taking us through what's about the 2026 filing.
Sure. Good afternoon. I'm Nisarg Sheth. I'm the Corporate Tax Manager at athGADLANG. A brief about the topics I'll be covering today. I'll be walking you through the lessons or the key lessons we have learned from the filing of the very first UAE corporate tax return. Now, this matters for two reasons. One, looking forward, these lessons help us avoid repeating the same mistakes on future filings. Number two, looking back, they also help us catch errors that may have already crept into the prior year return. Before I start, we can also introduce Amar.
Thank you, Nisarg. Thank you, Arslan Saab. Most people think an audit is about numbers. Frankly speaking, it isn't. An audit is about whether a stranger will believe you, frankly speaking, in our case, the FTA or any regulating body in that regard. I'm Amar Kagdi. I've been an auditor since 2009. It's been 17 years. I've been in the industry, but never have taken off my audit hat. So in that time, I've learned one thing, frankly speaking, that actually matters Companies don't fail because their numbers were wrong. They fail because nobody could explain how the numbers even got in the financials. So from an audit and tax perspective, tax tells the FTA what you have earned, but simply audit is what exactly makes them believe it. So within my time presenting, my only job in this would be to make you understand how important audit is for tax filings, and audit and tax go hand in hand. So over to the speakers to start off the session. Arslan Saab, please. Thank you.
Thank you, Amar. I'll be taking on the very first topic and the lessons learned from filing the first UAE corporate tax return. Moving on to the lessons. Lesson number 1, the first return was a decision document, not just a form. In year 1, many taxpayers either didn't actively consider their elections or made the wrong ones, leaving real benefit on the table. And because these elections are irrevocable, that benefit can't be recovered later. Choices like the transitional rules or the realization basis reshape the tax computations for years to come. Not electing was itself a decision, and often the wrong one. Lesson or learning number 2. The free zone companies mishandled the qualifying free zone person status. The second lesson is where we saw the most value lost. Several issues stacked up here. The taxpayers assumed that simply being registered in a free zone meant they automatically qualified for the qualifying free zone person relief, which is incorrect. When the return was filed incorrectly, they locked themselves out of the 0% regime and were pushed into the 9% standard rate for the subsequent 4 financial years. Correct data was sometimes entered in the wrong tabs of the return, or incorrect data was entered altogether. Without proper documentation and substantiation of the qualifying income, qualifying activities, and substance, the qualifying free zone person position itself becomes challengeable. Lesson or insight number 3. Groups that could have formed a tax group didn't. Entities that were eligible to form a corporate tax group didn't proactively apply for it. The result was that the losses sat trapped in the loss-making entity while the tax was paid on the profit-making entities. A set of option was available, but only if the application had been made proactively. Next slide, please. Lesson number 4. Losses didn't land the way the taxpayers expected. Some taxpayers assumed that the pre-corporate tax losses could offset the financial year 2024 profits. Again, incorrect. Those historical losses don't carry into the CT regime. Important point that going forward, current year losses can only be used to offset up to 75% of the taxable income in a given period. A point many taxpayers are still missing. Lesson number 5. That the small business relief was missed at the tick box. A number of small taxpayers who were eligible for SBR simply didn't elect it, and instead either paid tax unnecessarily or filed a standard return incorrectly. Now that's an active election, and missing it is a genuine cause of concern. Lesson number 6. Passive filing meant overpaying. This one closes the loop with lesson number 1. A return filed passively as a data entry exercise rather than a considered computation quietly but surely costs money. the exemptions and elections were there to be used. Taxpayers who didn't engage with them simply paid more money than they had to. For example, take dividends. Distributions from UAE resident companies are exempt outright, yet a number of taxpayers still paid tax on them, not because the law was unclear, but because no one revisited the computation. Example number two, taking foreign tax already paid, where income was taxed abroad, a foreign tax credit could have been claimed against the UA liability. Yet, some taxpayers left it unclaimed and were effectively taxed twice on the same income. Next slide, please. Lesson number 7. Transfer pricing disclosure caught filers off guard. Now, this one surprised people because the requirement sits inside the return itself, not in a separate process. Taxpayers who thought of transfer pricing as a documentation exercise for later found it was a filing gate they had to clear now, and it created a chain of holdups. Many taxpayers simply weren't able or aware that the return carried a TP disclosure, so they arrived at filing without having considered it. Auditors, in turn, wouldn't sign off the audit report while the underlying TP documentation wasn't in place. And we, as consultant, won't file until the documentation is ready either. So the gap cascades, pushing back both the audit and the filing. Lesson number 8. The return starts with the books, not MRA tax. Our consistent advice: always tie the return back to your books of accounts and financial statements. That connectivity means that if an assessment or order opens up in the future, you can substantively demonstrate how each number was computed and assessed. These records need to be maintained for the next 7 periods. Lesson number 9. The FTA rewarded the punctual. The AED 10,000 dirham late registration penalty was waived for taxpayers who filed on time, meaning within 7 months of the end of the financial year. This waiver has been extended for the current year, so the window to claim it ideally will run till 31st of July. Our recommendation is to act on it as soon as possible. Thank you so much. Over to Usman.
Thank you very much, Nisarg. I think now we'll move on to our next topic, which is what's new in 2026 filing. So moving on to handing over to Mr. Arslan for this, please.
Thank you, Usman. So the first development, what I wanted to talk about is a new one. This is a one-off election for investment properties held at fair value. So the way where the businesses has elected the realization basis for corporate tax, they may be able to claim a deemed depreciation deduction of up to 4% of the original cost each year. This is an irrevocable election. So the question is not simply whether the deduction is available, but whether making the election produces the right long-term outcome for the business. Property owning businesses should identify relevant fair value investment properties early, model the tax effect over the expected holding period, and ensure that the election is made in the first relevant tax return. For calendar year companies, this is the return due by 30th of September 2026. The second change concerns audited financial statements. The audit requirement now applies to all qualifying free zone persons, irrespective of the revenue. In addition to the businesses with revenue exceeding 50 million dirham. And tax groups also need audited special purpose aggregated financial statements. So this is particularly relevant in the audit context. So businesses should ensure that the financial reporting corporate tax return working and free zone eligibility evidences are aligned before they do the filing. An audit should not be treated as a final stage requirement. It is an important part of demonstrating that the tax position is supportable. Finally, the revised administrative penalty regime is now in force. For overdue corporate tax, the late payment penalty is 14% per annum, is calculated monthly. The framework has changed, also changes the consequence of errors and voluntary disclosures. The practical message is to act early. If an error is identified, assess it promptly and take advice before an FTA audit notice is issued. In our experience, early identification gives a business more control over the analysis, evidence, and appropriate compliance response. Next slide, please. For larger international groups, 2025 is the first year in scope for the UAE domestic minimum top-up tax, or DMTT. This applies to multinational groups with consolidated revenue of 750 million euros or more, and is designed to ensure a minimum effective tax rate of 15%. For calendar year groups, the first DMTT return is expected by 30th of June 2027, separate from normal tax return, which is due by 30th of September 2026. Although the filing seems distance away, the work begins now. In-scope groups need reliable ownership data, jurisdictional data calculations, and coordination between tax, finance, and consolidation teams. This should not be viewed as simply an extension to the corporate tax return. It is a distinct compliance exercise. The corporate tax return also now asks for detailed ownership questions. This is something which has been changed in the form recently. It requires disclosures of the intermediate parent and ultimate parent, and the ownership chain to the ultimate beneficial owner. Businesses should include their corporate tax, reconcile their corporate tax information with the UBO register and the licensing authority records. In an audit or FTA inquiry, inconsistencies in ownership information can create unnecessary questions and delays, even where the underlying position is straightforward. For free zones distributors, an additional compliance requirement applies where qualifying goods are distributed through a designated zone. This is a very recent change, and agreed upon procedure reports from an independent auditor is required to confirm the relevant custom and import conditions, and it must be filed within 30 days of the tax return. The action here is to map the relevant distribution flows and engage customs, tax, and audit teams early. This applies specifically to the distribution activity rather than automatically to every activity of a free zone business. Next slide, please. Okay. There are important refinements to the qualifying free zone person rules. The list of qualifying activities has been expanded, including certain commodities, carbon credits, and renewable energy certificates, as well as treasury and financing activities and commodity trading. At the same time, there is a restriction for businesses with substantial distribution or logistic revenue. This revenue reaches 51% or more of a qualifying free zone person's revenue. The revised conditions need careful consideration. The main message is that the free zone eligibility should be reassessed every year. A business may have qualified in the previous period, but changes in activity, customer profile, revenue mix, or operating model may affect its position this year. From an audit readiness perspective, businesses should retain clear evidence of qualifying income, the nature of activities undertaken, substance, and the basis of which the 0% position has been claimed. The other small point is the small business relief. The 2025 and 2026 tax periods are the final periods for which eligible businesses may elect for the relief. From 2027, every eligible business will need to file a full tax return unless FTA extends the SPR relief in future. For businesses that may qualify, now it is the time to confirm eligibility and decide whether the election remains beneficial, not simply convenient. Now, it is a very important message and time. The final theme is the enforcement and the digitalization. FTA increasingly is able to compare your VAT data, your corporate tax information for the same period. That make reconciliations very, very critical. A difference between your VAT turnover and corporate tax revenue may be entirely valid, but it should be understood, reconciled, and documented before you file that return. In audit support work, a clear bridge between the audited financial statements, VAT returns, and corporate tax returns is often one of the most useful documents the business one can have. It allows the businesses to explain its position efficiently and with confidence. For free zone 0% positions are also an area where businesses should expect scrutiny. They should be able to evidence qualifying income, adequate substance, excluded activities, and related party positions. Looking ahead, e-invoicing is no longer a future concept. The pilot began already in July. The businesses can implement voluntarily. For businesses with annual revenue exceeding 50 million dirhams, mandatory implementation starts from 1st of January 2027. The deadline to appoint an ASP is 30th of October 2026. This should be treated as a business transformation project, not just a tax project. Tax, finance, IT, procurement, and audit teams should be working together on invoice data, system integrations, internal controls, and the ASP selection. Next slide, please. Okay, so now I think, hand over to Amar.
Yeah. Thank you, Arslan Sahab. I think so for our next topic, it's audit readiness and how audit and tax connect. So I'm just moving the mic to Amar to continue this section, please.
Thank you, Arslan Sahab. Thank you, Usman. Assalamu alaikum wa rahmatullahi wa barakatuh, and good afternoon, everybody. Just so that everybody is listening to me, I would request to raise your hands if you can see on the screen up. So that I can see and check everybody's listening or not. I'll start, frankly speaking, with a simple question that I've been asked more than any other, and especially here in this part of the world. Do I actually need an audit? This has become not just a question; it's become frankly speaking, a cliche. Until recently, the honest answer in the UAE was it depends who's asking. Okay, nobody did give an honest answer. But thank God, Ministerial Decision 84 of 25 ended that. After that, 4 categories you can see on the slide. I would request you to read them as a filter. Land in anyone, and literally you're in. So starting off with the number 1 or the first one, which is a revenue above 50 million. So in terms of that, you need to prepare and maintain audited financial statements. Previously, it was just that if a bank is asking or anyone is asking, then. But now we recommend you maintain them. Number two, qualifying free zone person. And here is the best part that people miss, frankly speaking. In this QFZP, there is no revenue threshold. This is something that Arslan Saab also mentioned in his presentation as well, that if you are a QFZP, audit financial statements are not a paperwork or just a filing purpose. They are a condition for the zero rate that the QFZP will apply. And that's not a fine in terms of getting your audited financial statements. Literally, that's your entire tax position changing, because just getting audited financial statements to get the QFZP status. Number three, tax groups. This is also something which Arslan Saab mentioned earlier in the presentation. This is somewhat new, where you need to have a special purpose aggregated financial statement at any revenue. In this as well, like the previous one, there is no revenue threshold that the authority has kept. So if you have formed a tax group, to make your filings simpler, you may have just added an audit to your budget, saying that. And number four, non-residents with a permanent UAE establishment or nexus. There is a 50 million dirham test, which is measured on the UAE PE, which is a permanent entity or nexus, revenue only, and they don't talk about the global turnover. If we are only talking about the UAE turnover, which is 50 million, and that cuts both ways. So, and some of you might have assumed you were out, and now you need to think that what's your UAE turnover, and then catch up. So now the layer that catches people, coming to the good parts of the presentation. So the deadline for FTA or for filing the return is not your only deadline. Frankly speaking, now most of the free zones have their own audit submission deadline. Audit financial statements you need to submit. Ideally, it is most of across the free zones, which is 180 days from the year end. In the case of example, December 31st, 2025 year ended, the deadline from the free zones was 30th June, which in some cases have been extended as well, but in some cases, no, they haven't. And probably free zones tend to block their portals, they fine as well. But in this case, I would suggest that please don't take my number or date as it is. You directly confirm your free zones deadline now, this week, or going down the line in the coming days, because they are not the same. And the one that would matter is in which free zone or in which authority you are. Okay. Usman, next slide, please. Thank you. So now coming to the, from my perspective, it's the most expensive misunderstanding I saw in year one. Companies treated the audit and the tax returns as two discrete projects. They made two different teams, two different set of timelines, two different set of working folders. But if you see from a perspective where we are trying to explain you, is these are two things in one box, okay? Or they are not two discrete things, but they are part of the same chain itself, okay? If you look at the order of it, the audited financial statements are the foundation of corporate tax, on which the return is actually built on. The return doesn't sit beside the audit. It actually sits on the top of the filing itself. You cannot file a reliable return of unaudited numbers and fix it later. Later is just an amendment. And again, if most of you have filed the tax return, so an amendment is a flag to the authorities. So you always now to think, now you should think that audit and tax go hand in hand. Second, the calendars are nested, not parallel. Your free zone audit has to close before the return, obviously. if your return filing date is 30 September of the year, for a December year end, you need to finish off your audits well before your tax return is filed. So if your audit, for instance, slips 3 weeks, the return does not go 3 weeks more. It absorbs the delay, the tax team inherits your problem, and further, the problem trickles down to more problems. Coming to my third point, and I'll repeat it because this is one of the part that exactly costs real money for a qualifying free zone person. The audited financial statement. Again, I'm reiterating the fact, it has been said a couple of times during the presentation, that it's a condition for the 0% rate. Okay, so don't consider it as a formality. And now to the fourth, the FTA actually has now very sophisticated systems where they cross-match your audited financial numbers with your corporate tax returns, with your VAT filings, with your customs data. So FTA is now one body having all the data sets within them and cross-checking everything that's flowing in from different parts. So those days are gone that probably a business might consider that this stream of compliance is discrete, this stream of compliance is discrete. No, now everything, all the streams are flowing now into the same river. So here's the first principles version. An audit finding doesn't stay inside the audit. A delay doesn't stay inside the audit. Everything flows downstream, like I said, into the filing, which means the real question was never, when is my audit due? The question is, what is the earliest date I can hold the numbers I'm willing to defend, that I will be going to present to the FTA. So to my last thought, because you are not preparing for an audit, you might be just preparing yourself to be believed. So I'll just keep my thought here, and let's move to the interesting part again of our session, which is where the AI comes into play, bridging the tax side and the audit side. I'll again request Mr. Arslan Mushtaq Saab to take the floor, and I'll be pitching in with my audit side, and he'll be pitching in through his tax side.
Thank you, Omar. So AI, it's changing the way we do things in any business on a day-to-day basis these days. And likewise, the authorities are also adapting the AI more and more. So from a tax perspective, the important change is that the compliance is increasingly becoming data-driven. So FTA has access to your VAT data, your corporate tax data, your custom data, and your financial statements data as well. So this means an inquiry or an audit selection may be driven by the pattern, inconsistencies, or unusual movement across different sources of information. So now businesses should not view the corporate tax return in isolation. So the figures should tell a consistent story of VAT returns, corporate tax calculations, custom information where relevant, and the audited financial statements. So the difference is not necessarily a problem, but it should be understood, reconciled, and documented. So that's basically my tax perspective. So I'll hand over to Amar to explain the audit approach and evolving alongside it.
No, 100% agreeable, Arslan, what you just mentioned. And now let me tell you what has changed on the other side of the table. So for most of my career, or most of the auditor's career, being audited was mainly sort of a human event. A person or a human chose your file, which meant your real risk factor was honestly luck sometimes, that you might get selected or what. Then look at the numbers on this slide. As in FTA, like Arslan have just mentioned, that FTA audits up to 46%, probably plus minus. These are stats just for presenting purposes, and in terms of knowing that how fast the authorities are going in there in terms of the reviews, leveraging the AI and the technology itself. Almost roughly 1.7 million transactions reviewed. Inspections are up by 135% compared to last year. You cannot do that with people. Okay, the massive data that is coming across to the authority is basically being managed through models, and the audit sideline is the one to write down, which is cross data set inconsistencies, which triggers the selection. So nobody sits down and decides to audit you. There is a variance that decides. Even your VAT returns might say one thing, your CT return says another, and your audit financial says a third. Probably you have selected yourself in this scenario, that if even your all the three compliances that you have are not adding up, so voila, you got yourself. And again, reiterating the old question, which was, will they pick me? Might there be my luck not to be picked? But the new question is, does my own data disagree with itself? And what Arslan Saab and we were discussing in terms of the reconciliation part. So now it's all about engineering. So now, apart from the luck part, or apart from just being selected for the audit, you can anticipate the engineering that we are talking about, or the selection criteria which gets you picked up. So Usman, let's move on to the second part.
I think you
Yes.
already on
This is the
on
this
slide
is the
as well.
second.
Yes. So Arslan Saab, what's your tax side of the sampling and the population part?
So traditionally, tax reviews often focus on samples, okay, selected invoices, expenses, or transactions. Sorry, I was just getting a call in between. Technology has completely changed the dynamics. Okay, both regulators and businesses can analyze much larger data and identify duplicate entries, unusual timing, rounding number patterns, unexpected adjustments, or inconsistencies between systems. For tax teams, this raises the standard of preparation. It is no longer enough to be comfortable that a small sample looks reasonable. So businesses should be able to explain how the data population is controlled and use their own analytics before filing. The most effective approach is to treat tax data review as preventive exercise. Identify anomalies internally, investigate them, and correct or document them before they become an external question. So what's your view, Amar, from an audit perspective?
I think so, sir. I'll give my perception as well, but probably Usman Khan, who's our moderator, he's an auditor himself, so I would request him to just give his 2 cents as well. After that, I'll just pitch in my thought of the side. Usman, do you have anything to pitch from the audit side where it comes to sampling and the full population, and as of now in the AI age, how things are different in compared to the conventional sampling that we used to do?
Thank you, Amar. So I feel that since, of course, we through the decades we have relied on sampling tool like MUS and some judgmental sampling, because of course it was not possible to cover the whole population and the risk was always there. I think through AI, since now we do not have to rely on humans, we can rely on system which can process thousands of entries at once. It's much easier to minimize the risk from audit perspective, that we can get 100% assurance on a population, especially on the journals side, which is usually one of the most critical areas of the audit. So now I feel that through AI, the auditors have the opportunity which to further minimize the audit risk, and I feel that that is an amazing change in terms of the overall audit quality.
And you, like you said, that audit has always sampled, okay, but now it is practical now. Even the FTA analyzes full data sets. So the tools test every entry in just a matter of minutes, rounding dollar amounts or the currency amounts, phasing out unusual accounts, weekend postings, again, unusual posting that Usman you mentioned, entries booked after, like for instance, some of the journal entries. So sampling, frankly speaking, was never a principle. It was more of a, you can say, sort of a manual or a human-based compromise where we compare it with arithmetic. And that compromise in this AI age has literally expired. So now the 19,500 entries, probably just a number out of the ball. So nobody used to open, somebody opens them now, and it can easily be analyzed. So frankly speaking, as a professional, as an auditor, most of the audience probably might be the auditors themselves, might be the in the businesses, in the industry. But I would suggest, as a closing note for this particular area, sampling and full population, I would say that stop asking whether something will fall into the sample. Now, practically everything is in the sample. So just beware. So let's move on to the next slide, Usman.
Okay, so this one is also very interesting. Now the reconciliation carries a lot more weight than it used to be in the past. So now your reconciliation need to be very robust between the audited financial statements, the corporate tax returns, and the VAT returns. The reconciliation now serves multiple purposes. So it supports your tax return preparation. It also provides clear audit trail for the auditor, and also it puts business in a much stronger position if a FTA query comes up. The focus should include revenue, expenses, related party transactions, provisions, accruals, and significant one-off items. It is particularly important to document why differences are there. For example, exempt income, non-deductible expenditures, timing differences, or VAT treatment that do not follow the accounting revenue. A well-prepared reconciliation reduces filing risk, avoid last-minute explanations, and makes any future audit or inquiry much more efficient. So over to you, Omar. What's your view from an audit perspective?
I think so, sir, regarding the reconciliation part in year one or in the prior year compared to this one, this was the single hardest task, frankly, and this was true for almost every client we saw, reconciling these three things, the VAT, the corporate tax, and the audited financial statement. So it was, like I said before, that it used to be three different streams. When it got poured down into one, so we tend to find out that obviously there are differences, and nobody has even bothered to look from, as in terms of that, how they will be reconciled. So again, it remains a challenging part, and it's a top focus for the FTA as well. Frankly speaking, done properly today in this year, that reconciliations run continuously and can run continuously. The variances might suffer the week they appear itself, okay, and they should not be popping up before the month of the filing. So you need to focus from that perspective, that how everything is reconciled, it matches, and if you do it once, probably it can save a lot of time at the last minute or the 11th hour. So you need to focus more in terms of making sure that everything drills down to the same number that is being presented to the FTA. So Usman, let's
just to
hop.
just to add on something from the audit side, some practical experiences which we have seen in the last 1 year as well. So this is, I think this was already raised by Mr. Aslan as well previously, that FTA has a record of every single thing which we are submitting to them. So for example, suppose in one of a scenario, if the numbers which have been reported by a company in 2024 to the FTA, and then in the audited financials the next year, the the comparative numbers have a slight change, it will be immediately flagged, because that sort of control and reconciliation tools the FTA has. FTA is not only seeing your numbers for the current year, they're also matching the prior year numbers which you have reported to the FTA in your current year financials. So I think that is something which the companies and businesses have to be cautious about. That FTA knows. I mean, the FTA has excellent tools to reconcile things. So I think now I'll move to the next slide. Yes, over to you, Arslan sir.
Thank you, Usman. So here the text point is very straightforward. So early detection gives the business more options. The same analytical techniques that can identify unusual pattern during a regulatory review can be used by the businesses before the return is submitted. So for example, a review might identify inconsistent VAT treatment, duplicate postings, unusual manual journals, or movement that do not align with the prior periods. If an issue is found early, the business can investigate the facts, correct the treatment where necessary, and consider the appropriate compliance response. If an issue is found only after an audit notice, the position can become more constrained and potentially more costly. Our recommendation is to build a pre-filing tax health check into the annual compliance timetable. The aim is not merely to submit a return on time, it is to submit a return that has been stress tested against the data available to the business. What's your view, Amar, on this?
Sir, I presume, again, we coming to our last slide of the presentation. So the whole argument is, now I'll try to compress it, what we have discussed in the previous slide as well, in terms of the technical perspective and all. So FTA's anomaly detection, posting patterns, and the previous thing that I mentioned, that even the rounding off entries, timing, is not something very exotic to understand for anybody. It is essentially the same analytics the modern audit already runs on. The same test, same logic, same red flags. So when everything is same, so why not basically leverage and get it sorted beforehand? So like I said before, it is just a timing. The same finding cost, you a footnote in March. If you wait and watch, it costs you a penalty and a reputation in probably down the line in October or November. So the shift I'd like you with is this: the audit stops being a verdict on last year or the prior years and becomes an early warning system for this one, leveraging the AI part, making sure you are tax compliant. To end my conversation from an audit part and complementing the tax part as well, you cannot control whether you get looked at by the authorities, by the regulators. You can only control entirely whether there is anything to find. So getting your audited financial statements done, getting everything reconciled within your filings with the FTA, and finally, when you file the corporate tax return along with the ancillary filings, you are all aligned with everything. Again, leveraging with the AI part as well and the systems. So thank you, everybody.
Thank you, Omar. Thank you, Arslan sir. I now move to the last slide, which is the checklist, and giving mic to Nisar for this one.
Thank you, Usman. So the corporate tax readiness checklist. Having walked through what went wrong in the year one, let me close with 5 things every taxpayer should be doing now to be ready for the next cycle or for the future years. Number 1, reconcile VAT, corporate tax, and financial statement revenue. As mentioned earlier, the FTA is now actively cross-matching the CT, VAT, and customs data. So any mismatch will surface. Reconcile these three numbers before filing, not after a query lands. Number 2, close the financial year 2025 audit on time. A delayed audit delays everything downstream. PP sign-off and ultimately your filing. Timely audited financials are the foundation the whole return is built on. Number 3, keep the file complete. Maintain a single corporate tax file covering elections, qualifying fees on person substance, transferring documentation, as well as the loss workings. If an assessment opens up later, this is what lets you defend every number. And these records must be maintained for the next 7 years. Number 4, document the 0% position thoroughly. If you're claiming the qualifying fees on person exemption, over document it. This is the stated focus of FTA scrutiny. Substantiate your qualifying income, activities, and substance in detail and assume the position will be tested. Number 5, disclose past errors voluntarily before any audit notice. Voluntary disclosure made before an audit notice is now formally cheaper than waiting for the FTA to find the error. Once a notice arrives, that opportunity is gone. That's the checklist. Get these 5 right and you are not just compliant, you are defensible. That's the goal for the year number 2 and for the future years. Thank you.
Thank you, Nisarg. Thank you, everyone. So now I think we've reached to the end of the session. There have been a few Q&As which we have received. Passing this one to you, Aslan Saab. One of the question was that what is the deadline for registering for DMTT Pillar 2? Also, if all entities within the group need to register, even though only one would do the DMTT filing.
Okay, so look, in terms of the formal announcement on the registration deadline, so FTA has not announced anything, but the registration portal is open. So you need to assess whether it is applicable to you, and you need to then go and do the registration. And in terms of, it's not applicable to every entity in the group. So you just need to register the entity who is actually going to be doing the reporting. So that's how it is.
Perfect, thank you. Another question is, beyond meeting the filing deadlines, what governance practices should organizations implement to ensure they remain tax and audit ready throughout the year?
So I think we have covered a lot of those points during the conversation before as well. But I think there are few key things we summarized in the checklist, right? Having the reconciliations, so this needs to happen on a periodic basis. It should not be like a year-end thing where you are doing that. You are always assessing your tax positions you have taken and documenting it. Documentation is very, very important. If there are any changes in the business year on year in terms of your model has changed, your customer base has changed, or any significant change, then you need to go back to the drawing board again and make sure you are reassessing before it actually get implemented. So all of these things, I think these can be done built into the overall governance system of the organization to make sure that you are fully compliant throughout the whole year.
Perfect.
And Usman, I would just compliment what Arslan Saab mentioned here is that if you would see that in the recent months, ICFR, the internal controls on financial reporting compliance, has been applicable to given set of organizations within the UAE as well, which gives the organization a chance to have more solid internal controls, set frameworks, and get a report from the auditors as well on the ICFR. So even from a control environment perspective, the regulators and the overall the tax authorities are trying their level best to basically have a full-fledged compliance structure where everything complements to each other. So the organized, like Arslan have mentioned, that organization need to understand that how that corporate governance or compliance structure is relevant to their particular set of organization, their industry, their reporting based on basically, obviously here reporting requirements for public joint stocks is different, and for private entities is different, but still whatever the environment is favorable for them, which anchors them to be compliant, full-fledged, to be reporting to their relevant regulatory authorities, to the tax authorities, and so on and so forth.
Perfect. Thank you, Amar. I think the next question is, how can firms validate AI-generated outputs to ensure they meet regulatory and audit standards? Any specific process which AI can reliably automate, or human judgment is required at every step? Just to add on my stance on this question, of course, I mean, the AI do have to validate AI generated content as well. I mean, there is no question about that the human intervention will always be over there to check. So I think I mean, based on our understanding, no critical decisions can be made solely on what has been produced through AI. For the specific process which AI can reliably automate, it can be any process. See, AI can actually audit AI itself. So it's up to the user. So it's up to us that how efficiently we create those skills within the AI that and create those automated segregations. You know, the filters, the second line of defense, which can detect and prevent any anomalies in the financial, I mean, in the MIS or anything at all. So AI can automate anything, but of course human intervention would be there, human judgment would be there, and just to audit or just to make sure that what is being created, the outputs of the AI are of the correct standard. So I think for that, it depends on what sort of output you're getting. If it is coming, if AI is, of course, AI goes through information which you either put or you either you know, point it to. Maybe it's taking it from the internet, it's taking it from the FTA or any other website. So what you need to do is, if you need to see the output is reliable, you need to see that what are the sources which AI has used. So this is my stance on this AI thing. Arslan Saab or Amma, if you want to add something to it.
To be honest, I think you summed it up very nicely. Look, my perspective on AI is AI can never take away the human judgment element away. So yes, we can use AI to our advantage to do a lot of the prep work and a lot of the processes, automation, etc. But at the end of the day, it still needs to be reviewed, looked at by a human, and a judgment needs to be applied. So that element will not go away. I think we have ran out of time.
Yeah. We do have a quick 2 queries, Arslan Saab. We can just wrap it up quickly. It is a query from the text team of whether upward transfer pricing adjustment will have to be made by the way of VD revision of the CT return, or can a prior year adjustment be taken in the current year's return and discharge it right away?
To be honest, I'm not really sure whether this is talking about a prior upward adjustment which was not taken, and that is something which somebody is trying to do. But look, the upward adjustments as a principle in the tax returns, they are allowed. The problem is only with the downward adjustments as far as previous year is concerned. But now FTA has also come up with a different mechanism where you can take the downward adjustments without necessarily having a written approval, etc. So I think that is something which needs to be understood, the context behind it, before I can give a sort of right answer for this.
Fine, perfect. Thank you so much, Aslan Sab. There's just one last question I'm taking in, which is for the audit team, whether a tax disclosure is required in the tax group aggregate AFS. Generally, no, it's not required, because if putting in a nutshell, the FTA has its own format for an aggregated financial statement on the FTA's website. If anyone is going to is going to submit those financials, I suggest take it from there. And however, the FTA has beautifully instructed every single disclosure and how to what extent it should be. The AFS submitted to the tax authorities is usually condensed. It's not a regular FS. And it cannot be used for general purpose either. It cannot be used for any other filing except for the FTA. I think the way the disclosure should be there in the FTA's approved format for the tax payable and receivable, it has to be followed exactly in the same way. So I think we have covered everything today. I think we have a few more questions, but of course we have just gone above the time we had. Thank you everyone for attending this session, and I wish you all a lovely day ahead.
Thank you.
Thank you so much,
Thank you so much
everyone, for attending. And then we'll look forward to seeing you on our future webinars.
And looking forward to connect with you as well after this.
Thank you.
Thank you.
Everyone.
Thank you.